All right. Good morning, everyone. Welcome to Stocks and Coffee. Paul Singh here. I know it's his canal right there, but it's Paul. We're going to talk about a lot today. Give me a little shout out in the chat. We'll do some quick shout outs so everyone can get in here. Fernando already knows the drill. A bunch of you already know the drill. Let me know where you are and if you are drinking something, what you're drinking. I've got my Bird Rock coffee here, a local San Diego place. Let's see here. We've got Fernando. What's going on from San Francisco? I got my Niners hat on. Big game tomorrow against the Rams. Kuram, what's going on? My buddy here from Houston. Make sure we meet up after this session. Will, what's going on from Jacksonville? Hawaii Blend Coffee. We got Brent. What's going on, Brent? Richard, what's going on? Wishing everyone a happy weekend. Ron from Jacksonville as well. Do you guys know each other? Will and Ron, both from Jacksonville. Caesar, my buddy Caesar, what's going on? We're going to get together next week. Brent from Alabama, old school Folgers. I do that every once in a while. Get the quick instant coffee. Nara, what's going on from New York? Timothy from Chicago. You can't go wrong with Dunkin' Donuts coffee. I had that last week with a chocolate bar. Randy, what's going on from Chicago? Fernando's drinking green tea, probably the healthiest one here. Tom, what's going on from Philly? We have Chris. Big turnout this morning. We've got Chris from Kitchener, Canada. I've never heard of Kitchener. I have no idea where that is. Is that on the left coast or the east coast or middle? I don't know. I don't know where that is. Mine's from San Jose. I was there just a little while ago. We've got Oksana from Irvine, not too far from me. Jeff from Texas. George or Jorge from Boston. George. All right, George drinking tea. Will. Oh, all right. Will and Ron have gotten together, so they know each other. All right. Richard from New Jersey. Cindy from Tennessee, Blackout Coffee. I've never had that. And we've got Chris here from Toronto. Okay. That spot is just outside of Toronto. All right, good. Okay, all right. A lot to talk about today. We're going to talk market analysis. We're going to game plan for next week. Go through some industries and some stocks that we're paying attention to. Of course, we're going to review big tech as well. And we're going to go through industrials and kind of go through an easy way for you guys to build a watch list without doing too much work. And we're also going to talk options a little bit. I don't know how many of you actually trade options. Actually, why don't you guys let me know in here, just a yes or a no, whether you trade or have dabbled in options at all in the past or now. I have an options class coming in a couple of weeks. So I have actually a link page, which I'm going to give you guys. We won't spend too much time on this, but we've got a link page here, and it's a $7.97 class. But if you join through here, it's only $4.97. And what I want to go through today, whether you trade options or not, or we're going to take the class or not, it's something you might want to look into. One of the reasons, there's many reasons to trade options. One of the reasons is the extra leverage. Now, leverage can hurt you, but there's smart ways to handle leverage. And the nice thing about options is sometimes, I know, especially traders, small accounts get priced out of options. Like, it's very tough to trade a bunch of shares of Netflix right now because it's trading over 1,000. So even if you have a $100,000 account, 100 shares is going to use up your whole account. So it helps with leverage if you do it smartly. You can get crushed with leverage, but we know how to do it smartly. And I'm not going to really teach it today, but I want to give you guys an example using a couple of different option strategies, how it gives that leverage to you and a smart way to do it. So I'm going to post that link in the chat here. I don't know if you guys can, through Zoom, I don't think you can copy and paste the chats, if I'm right about that. But just go to Bulls on Wall Street Traders /swing options, and you'll have access to that. And again, there's a good discount right now before that goes to the regular price. All right, let's talk market analysis here. Let me see how many of you guys actually trade options. Good mix of people who trade options. Nice. And then a few don't, but want to learn. All right, good. Okay, let's talk market right now. Market analysis. We always use a top-down approach. I recognize a lot of the names in here, so I'm figuring most of you guys know what we're talking about. And that is, even if we're not trading the market, we're focused on stocks and what our setups are doing. We want to know what the overall edge in the market is. As we've seen for a while now, a lot of stocks become very correlated with the overall market. So we're always paying attention to what the market's doing. And the way I always like to describe, we have this, even though we're swing traders and we've got a toolbox of setups that we're using, we have a lot of setups, right? Depending on, how you trade, you might have 20, 30, 40, 50, 60 different setups you trade. And the question is, I've got this tool box, like someone who works with tools, how do I know what to pull out, which tool to pull out, right? And the market analysis is going to tell that. Do I use a hammer? Do I use a screwdriver? Which setup do I use? And the market's very clear right now in what we should probably be using at this point in terms of setups. So let's do a quick review here. We see the market had been in a very strong trend, and we see one thing that really jumps out on the chart is this big decline here. This was when there was the battle between China and Trump over rare earth metals and potentially tariffing those, and the market had the big decline. And when we're in these big trends, especially when they're getting kind of long in the tooth, any little bad news can set the market off. This really wasn't a huge deal. And we've been through this a million times now with the tariffs, right? China does something, Trump doesn't like it, he threatens them with tariffs, they negotiate, and then it's in the rearview mirror. We've seen that over and over again. Yet it still spooked the market. Logically, we knew that what is likely to happen, nothing is 100%, but we play odds all the time, right? We could say maybe 80% chance that this is going to be minor. We have the big decline. Maybe it was going to decline a little more. Eventually, it gets back on trend. We didn't think it was going to be this quick, but we were already talking about that when that happened. So we didn't panic. We stuck with a lot of positions, even some of them that were hitting stops. We kind of played through them a little bit, and the market got back on trend. Then again, when the market is in this kind of not bubblish, but a little frothy kind of trend, any bad news will send the market down. And the market pullback here, surprisingly, was related to one stock's earnings reaction, and that was Palantir. So if we look at PLTR, if you guys were trading when, and most of you probably were in the last few years, when NVIDIA was doing this, where NVIDIA was the big market tell, and whatever NVIDIA did, it tended to be what the market was going to do. And before that, it was Tesla. And right now, it's Palantir. So what happened with Palantir was it had earnings, and it had fantastic earnings. Blowout revenues, blowout earnings. And not only that, sometimes you'll see a dip if earnings are good, but we're future looking. If the market warns in their guidance, then maybe the stock will go down. But they didn't even warn on guidance. So you would think because of that, that Palantir would have popped, but it didn't. Instead, it had a negative earnings reaction. I don't remember the exact percentage. I think somewhere around 10%. You could see where it was before earnings and where it dipped to. And that kind of took the market off guard. Again, one stock essentially doing this, but the market's looking for an excuse to pull back at these levels. And that's what we got here. And we talked about this before it happened, that maybe with Palantir, there's going to be a sell the news event because it was already extended. And that's exactly what happened. And that impacted the market. And you can see here, the market started to decline around the same time. This is healthy, actually. It seemed a little, when this started to happen, you heard a lot of talk about bubbles. And our theory was, this is not a bubble. If we look at a number of different factors, this is usually not when bubbles arise. The other thing is, when everyone's talking about it, that's not usually when it happens. It usually happens when the market becomes irrational. No one's talking about it. Everyone's saying buy, 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 and the market's extended. That's usually when the bubble happens. And if we look at fundamentals as well, in terms of valuations, PE ratios, and all that stuff, this is usually not where bubbles happen. I actually wrote an article here late last week. Are we in a bubble? Not yet, but the air is getting thin. meaning we're not in a bubble, but we are kind of up there. I would recommend you read this article because we dig into past bubbles and some of those fundamentals we were talking about. pauljsingh.com, and it'll be the first one, or you can just use the whole link here. But I think you'll like this article. Brent's got a question. Oh, these things. At the end of the day, we're looking at price action and what the technicals are telling us. So we were watching this level. My line is still there. We were watching this level very closely. We weren't making any decisions on it. I always say, even if the market's a little worrisome, you can take a trade here or there, manage your risk well and so on, but don't get too aggressive. And we were very cautious through this period. We wanted to see if the market would hold here, and it did not. And you can see here, this was Thursday's action, blew through the old high. And then the next test after this level, we said was going to be the 50-day moving average. And look at what happened on Friday. Look at this hammer. When you see a hammer candle, now there's some people will trade hammers maybe incorrectly. Hammers only really matter when you're extended to the downside, when the market is oversold. If a hammer forms within a range, it doesn't mean anything. But you can see here, the market was extended. Look at where stochastics is an overbought, oversold measure. And you can see here, it was on the downside. And then we can just look at the price action and see. SPY was up here at 691. And by at some point on Friday, it was all the way down to 662 very quickly. So extended to the downside. And then by the end of the day, a hammer had formed. So this is a very strong signal here that the market's going to go back on trend. Now, every once in a while, it's a fake out, so we don't want to get too aggressive. The only thing I did on Friday was I took a position in a leveraged ETF for the Qs, and you'll see the same thing on the NASDAQ here. If we look at the Qs, very similar pattern here, another hammer. It doesn't matter if the hammer is red or green. It closed slightly, red here, but the hammer is there. That's really what matters. And there are a couple of reasons I use the Qs. We use leverage ETFs, so I use TQQ to get the triple leverage on this thing. So, we're swing traders. We want volatility. So, we want a big move. So this gives us triple the leverage. Essentially, it'll give us triple the percentage gain. So if the Qs through this period ends up being up, 8%, this thing would be up 24%. Now it's a double-edged sword because if it was down, this thing would go down as well. So you have to be wary of that. But that's the only thing I did on Friday. And now we'll look for confirmation next week. Do we get closes above this level? It'll be really good if we close above this old high and the 9 EMA, which is about the same point. And you just slowly get more and more aggressive through this period as the market gives you more and more clues. Now it could fail, and then all we do is get stopped out of the TQQ Q position. We gave it a lot of room too, in case there's some volatility. So that's essentially what we're seeing with what I'm calling the AI momentum pullback. This was the Trump-China pullback, kind of a one-day pullback. And this was essentially the AI momentum stock pullback. These are the things that really got hit during this period. Started with Palantir, then all of those quantum AI, energy stocks related to powering AI that have been running like crazy. They all started pulling back hard. And a lot of our momentum stocks, like this Focus 50 list I keep here, is essentially our favorite momentum stocks. And these things were hit very hard too. And now a lot of them are forming either hammers or a piercing pattern, which are both bullish patterns. And we're seeing a lot of that across the board right now. So that's essentially what we're looking at right now. We're looking at those reversals off the pullback. Now, one other thing, let's talk about seasonality. We went over this in our pop-up session for Bulls on Wall Street. I'll just pull this up here so we can go over the numbers. November tends to be one of the strongest months during the year, and combined November, December, one of the best periods to trade during the year. If you were only trading 2 months out of the year, these are the 2 months to do it. Tend to be very strong. going into the end of the year. You have November seasonality, you have December seasonality, Santa Claus rally, which tend to be very strong. Going back the last 30 years, November is up 72% of the time. And I think if you go back like 50 or 60 years, it's up almost 80% of the time, but 30 is more relevant for us. So up 72% of the time. S&P 500, generally up about 2%, the average. Qs, 3%, IWM, 2.7%. That's another reason I picked the Qs, is it just tends to be a little stronger during November historically. So went with the Qs. Less volatility. Sometimes when you have these big kind of months, there's more volatility. There's actually less volatility. On average, VIX drops 5%, giving you a clue that there's not a ton of volatility. The tire market tends to do well, but the best performing industries historically during this period are industrials, semis, and with semis now we can put the AI, the quantums, the energy related to that as well, and retail, which has been hit very hard recently, but tends to be a very strong industry. And then your momentum leaders, especially small caps and mid caps. Small caps and mid caps tend to do very well towards the end of the year. And also stocks that have been leading during the year do well November, December. And there's this kind of phenomenon related to that, in that if we're thinking about the why does this stuff happen? There's always a why behind everything, right? The why behind this is, think of all the money managers, all the hedge funds, and so on, when they're talking to their clients, and let's say Palantir has been one of the leading stocks. If they're not in that stock, the client's going to say, "Hey, why aren't we in this? This is a leader." So even if they weren't in that, they tend to be in that towards the end of the year, just kind of window dressing essentially. So always look to the momentum leaders. I always keep a list of at least 50 of the best performing stocks in November and December and trade a lot off those because they tend to do very well towards the end of the year. Now, the other caveat here with seasonality is 72% of the time, right? That means 28% of the time they have been down. November has been down. So this isn't a hard and fast rule. It's just another thing giving you an edge, right? Your setups give you an edge. Your market analysis gives you an edge. Your risk control gives you an edge. This is another thing that gives you an edge, but it's not guaranteed. It's not 100% of the time, but you just know you have that edge during this month. And it's always good to look at and play seasonality. But at the end of the day, we look at the charts. November started very weak, which it doesn't tend to do, which is already kind of bucking the November trend, but we'll see what happens after this hammer has formed here. So that's our market analysis right now. And then the question is, what do we do with that game planning? And I've got a few questions. Let me get to your questions here. Danny's saying in the article, I see there's a reference to Burry. Yeah. So if you ever saw, if you read about him, or if you watched the movie Big Short, this guy made a fortune during the 2008 meltdown, and I talk about that in the article. But what we point out there, because it's been in the news, if you don't know already, if you follow Twitter or CNBC, they all talk about him. And he is like, I think like 80 or 90% short right now. He's shorting Palantir, he's shorting AI stocks. So he's going very heavy with his puts right now. But he does manage his risk. He's using puts. And also, they talk about his 2008, the killing he made in 2008. But he was getting crushed before that because he started shorting, and I think it was 2006. And he was losing a lot during this period. A lot of people thought he was crazy at that time. So don't look at something like that. I've already had people contacting me, "Hey, Burry's short. Should we all be short now?" He was 2 years early before he made his killing. And we're not trading these long-term trends. We're short-term trading. So if we just short now early, we're going to get crushed. So we want to wait and see for the signal. So don't look at Burry and say, "Oh, he's shorting. I need to be short now." All right. Donald, I'm not Kunal, I'm Paul. I know it says Kunal up here, but I'm Paul. But don't you think this year may be different due to the government shutdown uncertainty? It does. Yeah, there's always something, and every year is different. So we're looking at seasonality, but like we said, not a hard and fast rule. So we're going to look at the charts now. Now, the government shutdown is going on right now, but it could end at any time. A lot of people are predicting it'll be done for various financial reasons before Thanksgiving. So we'll see how that plays out. But yeah, that is definitely something to think about, and we should be watching our charts. I don't want to make a prediction on gold, but gold does tend to do well towards the end of the year. We see the big dip here. There's a gold miner stock I'm watching very closely right now under here, rare earth and metals. That's IDR. But tends to do well historically end of the year. But we'll wait. I'm going to wait and see for it to tell me that it's time to enter. Danny mentioned that he's highly short NVIDIA. Yeah, that's not surprising. Uh, do you have any interest in precious metals? Yeah, I am watching them. Mark, which list? I forgot which list I had up. This one here. Okay, all right, good. Okay, so we're gonna have our game plan. We're gonna go over the game plan here. Let's talk a little bit about options, then we'll get to our game plan for the week. Already asked the question, how many of you trades options? And a lot of you do. I like that. And then a lot of you who don't seem to be interested. I think it's a lot of work. One thing you should never do with options is just jump in. There's that old saying like 90 something percent of options traders fail because they really don't know what they're doing. So I would not trade options until I've really studied it in depth. But what I want to, and we're not going to really get into the nitty gritty of options right now. But what I want to do right now, really quickly, is show you guys how you can use leverage with options and use it smartly. So real quick here, you got a lot of you guys said you trade options. Those of you who do trade options, do you just buy calls? Do you sell calls? Do you use more complicated strategies? Like it's not really that complicated, but debit spreads, synthetic longs, anything like that. If you do, just say yes or no in the chat here. For those of you who do trade options, or what you do, what type of option strategy you do. But what I want to show you now is how these different option strategies can help, especially with smaller accounts. And it's not even smaller accounts, even bigger accounts um, in terms of leverage and risk control. But let's say you even have a $100,000 account. If you want to buy 100 shares of Netflix right now is trading at over 1,000. So essentially, if you want to trade 100 shares, you're going to use up your entire account unless you're on margin. So a lot of times you'll go 20 shares, 30 shares, right? Because you don't want to use up your whole account. Well, you could use option help a $100,000 position. Now you might only have a $5,000 or $10,000 position, and that gives you a lot more maneuverability in your account. Okay, most of you seem to be doing simple call and spreads. Some of you do vertical spreads. All right, good. Okay, so let's do a quick comparison against. We're not going to get into the strategy and pricing and all that kind of stuff, but I just want to give you guys an idea of how options can help you in terms of leverage. So what we're going to do is we're going to take a stock we like right now. Two that I like right now are AMD. You can see AMD obviously has been doing very good since the low here. Broke out over its high and then pulled back to that high with the market pullback, but held up really well. And what I've been waiting to see now, is it going to hold this level? And it formed this level. So let's say we liked AMD here. Another stock that I'm interested in right now is Hood for various reasons. One, it has been a yearly leader. So it fits that kind of strategy we talked about, like look at the yearly leaders. So same goes for AMD. And then notice here, again, showed relative strength, has a high right here, and is holding barely that 50-day moving average right now. So let's say we like Hood right now. So to buy here 100 shares of Hood as in our normal swing trading would be 130 times 100, obviously. So about $13,000, right? If you have a $100,000 account, that's fine. If you're trading a $10,000, $20,000 account, you're using up a lot of your account, or you're just going to take less shares, right? Maybe you take 20 shares. But now let's compare. Let's say we want 100 shares of Hood, $13,000. Now let's compare that to buying a call. Three different strategies here. Buying a call, using a debit spread. We're going to use a bull call spread. or a synthetic long. And none of these strategies are that complicated. So I've got hood up here. Here is buying the call. So notice here, we are buying at the money. And if you don't understand what that means, that's okay. All that means is the strike you're using whenever your option expires is at the money, meaning it's at about the same price as the stock. You can never get it exact. So it's trading at 130.36. There's a 130 strike here. So basically at the money. So notice here, if we just buy the call, that 13, you're basically controlling 100 shares. That $13,000 position now only becomes 1612. So you've already got the leverage, right? So that's good. If you only have a $10,000 account, now you're only using 1600 of it and you have a lot more maneuverability, right? You could take, if you're trading options, you could do like 8, 9 more positions versus trading the stock where you're probably going to use up your whole account, or you could probably only trade 1 or 2 positions at a time. So this gives you that leverage. And that sounds great. So you're like, okay, why wouldn't I always do this? It went from 13,000 to 1600. Remember with options, always think about this. Any advantage you get, there is always a disadvantage you have to think about. And just look at the profitability here with the bull call spread. If we go to the strike date, I went to January 26 here. So essentially a couple of months here to hold. It expires on January 26. So that's a big difference. There's a time element to this, right? When we buy our stock, we can hold it as long as we want and we're not penalized, right? Outside of we're sitting on it, but financially we're not penalized by it. We can hold it through the whole time, and we're not going to, if it stays at 130, we're not going to lose any money, right? We're just break even at that point. If you're holding your option, every day you hold it, you're losing money. That's called theta. And in the class, we'll get into Greeks more, but you're losing a certain amount every day. And that's reflected in this chart here. Notice the long, let's say it stayed at 130. That's this dotted line here. Every day you hold it, you're losing your money. If it didn't move and hood just stayed at 130, I'm down $5. On the 13th, I'm down $31. On the 24th, I'm down $171. By the end, I've lost $1,512. Essentially, everything I paid, I've lost. If it just stayed at that price, right? So the stock has to go up or you actually lose money rather than just breaking even. So that's a negative. Obviously, you have a break even number. Here, if you hold to expiration, your break even is 146.13. So basically, if you hold this thing to expiration, the stock has to go from 130 to 146 before you start making money. That's why oftentimes buying calls is a losing proposition, because you're already kind of in the hole, right? Most people who trade options and buy calls exclusively are losers. Not personally, but losing on their trades. Professional traders tend not to do this. There are certain situations where you make exceptions and you do buy calls, but in general, this is not what you want to be doing. And so the leverage is great, and sometimes it's worth doing. And notice here, if you think there's going to be a quick pop, you don't lose that much, and your break even is much lower, right? If you hold only till November 21st, your break even looks like it's probably somewhere in here around 133 or so. And we have ways to calculate that, but this gives you a good rough idea here. So I need to get to 146 to make any money, and anything under that, I'm losing money. And if it expires under 130, I lose my whole $1,600, lose everything I put into it. I can't lose more than that, which is good though. I can only lose 1,600. So my $10,000, if I have a $10,000 account, now it's about 8,400. But you can't lose more than that. All right. So this is buying the call. Now let's look at another strategy. We're not going to go deep into this, but there's a strategy called a bull call spread. And what that is doing is pitting buying a call versus selling a call essentially against each other. You're going to have a buy call and a sell call, and that's going to create a floor and ceiling for you. So what that's going to do is, and you can see here, now we took hood. Actually, let me go back to the buy call real quick. We've targeted 150. The top of the range is about where we're going to take profits. The exact top is 153. So let's say we're looking at this, and as a swing, I was going to enter here, and I was going to take my profits at 150. So if we look at the buy call here, if it hits 150, I'm going to make $788, which is pretty good off that 1,600, right? What's essentially a just a few percentage point gain on the stock is going to make me like a 50% gain on what I put in here, right? 1,600 it would go up to about 18, yeah, 50% gain. So that's pretty good. So you can see, again, the power of it, but the problem is the break even. And notice here, I keep making money the higher it goes, okay? Higher it goes by that expiration date. Now, when I do the bull call spread, there's some advantages and disadvantages. One of the biggest advantages is it gets even cheaper. No, here the way, and we can construct it in different ways. I use these strikes, and the more you move them, this will change some, but it gets cheaper. So this was 1,600 to do. Now with the bull call spread, it's 992. That's because you're buying and selling against each other. You're getting a debit and a credit that you calculate. And again, if you don't know too much about that, just know that it gets cheaper. So now it only costs us 992. So it's even better in terms of leverage, right? And I've capped my risk. So what you're doing when you're doing this is you're creating a floor and a ceiling. So now with that 125 call here, I can never lose more than 993 on this thing. So that's kind of nice. If this thing were to gap down huge, if I bought this stock 100 shares and it's gap down 20 points, I lose $2,000. If it gap down 30 points, I lose $3,000. I could never lose more than 993. It could gap down way down 50 points. I still only lose 993. Created a floor. So that's really nice with these spreads. Again, why would you not always do that then if you've got this floor and essentially this hard stop that's put in for you, no matter how low the stock goes? And again, with options, every advantage creates a disadvantage. The disadvantage is I've capped my ceiling. Notice here, once it goes to 1,500, I don't make any more money. Whereas here, if it kept going higher, I would continue to make more money. So where I like to use these spreads, and I almost do it exclusively, is when I know I have a target that I'm going to get out at, like here, I would be getting out here, I'll use a bull call spread. Now, if I'm trying to ride a bigger trend, I won't use that because I'm capping my potential profit. But here it doesn't matter to me because I'm always getting out at this spot. So I can use a bull call spread. I can protect myself. It got very cheap. And also notice I still have a higher break even, but it got much better. My break even on the buy call was 146. Now I've lowered it to 134. So my break even is better too. I start making money at a lower level here. And if I target that 150 range, I'm going to make 1,500, which is more. Even it's interesting that even though I capped my reward, I'm still making one more at 150 than I would with just buying the call. So you can see all these advantages with the spread. So I trade spreads much more than I do just buying a call. Now, if it starts going higher, you have an advantage on the bull call. Sorry, on the long call because you've capped it at 1,500. Okay, so that's the bull call spread. Now you can also use a synthetic long. And what you're doing with a synthetic long is essentially mimicking the profitability you would get with just buying 100 shares and doing it very cheaply. So it's almost feels like too good to be true when you look at it because look at your net debit. It went from 1,600, it was going to cost you, to 992 to $130. Look how cheap that is. And my profitability is almost exactly the same as if I just bought 100 shares. But again, with everything in options, every advantage, which these advantages seem amazing here, there is kind of equal disadvantages. So one disadvantage is you are on margin here. So it's only your outlay is only 130, but you're on margin at 2,500. So you have to have that much in your account and a margin account. But the actual outlay is only $130. What you're doing is buying a call and selling a put, and the difference between the cost of that creates your net debit. Here, notice your profitability now at that 150 target. We end up making now 1870 instead of 1,500 on the bull call, and I think it was about 800 on the sorry, 1,500 on the bull call spread, about 800 on the bull call. So we're making even more. Our profitability is not capped, so we keep making money the higher it goes, right? But you can probably see, and notice here also our break even has decreased. It's almost negligent, right? We enter at 130, our break even's only 130, 130. So almost nothing here for our break even as well. So this is fantastic. The profitability part is amazing on this. The disadvantage is the bull call essentially caps your risk to what you paid, right? The bull call spread caps your risk to whatever floor you created on your no, look. Notice here, if I do it at 130, it goes my max risk goes down to 735. If I put it at 120, it goes to 1200. If I put it at 125, I can create my floor here, and I'll never lose more than that. The huge disadvantage with the synthetic long is you're not capping your downside as well. It keeps going down as low as the stock, just like you do with your stock, right? You don't cap your downside here, so you have to mentally put a stop. So that's what you have to do here with the synthetic long. In every other factor, it's amazing and better than these two, except protecting your downside. So you have to have a stop kind of in place, just like you do when you trade a stock, right? And if you're not disciplined, you'll keep losing money. And if there's a big gap down, which happens occasionally, you'll lose more than you want to lose. Like I could cap it and say, I think this can go up to 154 where I make 2270, so I'm willing to lose 1,000. But you can have that stop in place. But if it gap down more, you would lose more than that. Or if you hold it longer, you're losing time as well. So you have to think about that. So various ways, you can see with options, there are all these different strategies. There's many more strategies in this. But you can see the huge advantage of doing this if you know what you're doing, is that you can trade your exact swing setups, but make it much cheaper to do and potentially make the profitability better by using options. So a little introduction here. Obviously, it's much more in depth than that. And again, if you're interested in the options class, go to this link here, Bulls on Wall Street, traders.com/swing options. And I'll put the link in the chat again. And I don't think you can copy and paste it in here. There's a link. It's $4.97 right now, regularly $7.97, and the price I think is going to go up on the 15th, I believe. But if you have any questions about that, let me know. Now let's get to our game plan for the coming week. I think I have more questions here. Let me take a look. Brent says Webull only allows him to do straight long calls. Yeah, whenever you answer those questions, you should probably tell them that you probably answered your. They usually have a question sheet for these more complex strategies. Sometimes your broker will not let you do them because anytime you sell, you're on margin and they're on the hook for that. So they want to know you know what you're doing. So always answer those questions in the positive, and of course know how to do it. Okay, good. Danny, I think you have the same issue where they're just not letting you trade some of the other stuff. So start trading the basic way, and then start and request them to give you access to some of the other stuff. Okay, all right. Okay, now let's get to our game plan for the coming week. We talked about this already. We know where in terms of the market. We have those hammers forming both in the market and a lot of the stocks that we are trading right now. So looking very bullish. Sometimes these things are fake outs. And this happened on a Friday. We have the whole weekend. We know a lot of times, whether it's tariffs, whether it's Trump, whether it's China, or whatever it is, oftentimes there'll be some news over the weekend. So we just want to make sure this is not a fake out. So my recommendation here is kind of a slow build. We dipped our toes in the water, and we already have positions as well. So that made it, we already have 3 or 4 positions. So if the market does move, we're already positioned for it. But in terms of added 1 position on Friday, which was the Qs and the leverage ETF TQQQ. Now, Monday and Tuesday, watching very closely for confirmation. If we see continuation here, especially if we get up over the 9 EMA, we start to get more aggressive and start adding more of the stocks that we like. So that is the plan right now. In terms of setups that I'm trading, essentially we're trading our earnings related setups. And let me just do a quick ugly drawing here of some of what we're doing. And that is earnings related setups and trend pullbacks. So for the get rid of that. For the trend pullbacks, what we've seen a lot of is stocks that were on these trends, right? And now they made deep pullbacks. And a lot of stocks, especially the AI related, the momentum stocks, quantum energy, and so on, they violated a key support level like the 50-day moving average. And now we're watching for these things. They already put in some nice candles here on Friday. And then we want to see them go over the support levels that they broke, what we like to call remounts within trends. So if we see that, we're going to enter that. That's one of my favorite setups right now. We also like stocks that had gapped down on earnings. And I know this sounds counterintuitive, but it seems like, bad news. We should be shorting or staying away from these guys. But what often happens is these are overreactions to good stocks. Like Palantir is an overreaction. So what we're waiting for is shows of strength or reversals in these stocks that gap down. I really like when they pull back into the gap, or when they when they essentially invalidate the gap down and break through this level. So we're looking at that on gap downs, and then on the gap ups, we're looking for ranges and range breaks or pullbacks and holds of support levels. So that's essentially all I'm looking at right now. So out of the basket of however many setups we trade, this is all I'm looking to do this week. Kind of the money setups, the one we've identified as the best setups to be trading right now. So that's what we're looking at in terms of how we should be building our positions and key setups. In terms of some industries and stocks we like, banks have been showing relative strength. We're in JP Morgan right now. Of course, quantum AI, all of these guys have deep pullbacks, but they look like they're ready to get back in trend. Industrials have been showing relative strength. Of course, we're always looking at big techs. These rare earth stocks and metals were doing well before the Trump China thing. They got hit hard with the tariff news, and they hadn't really bounced back yet. But now, after these deep pullbacks, they're starting to show some strength. So we're going to watch these very closely, and then of course some of the earnings plays. So let's take a look at some of these stocks. I'm just going to pull up XLF here. This is the ETF for financials. If you just want to trade the ETF, and you can see it even on the pullback, it didn't pull back very much. The market pulled back much deeper than XLF did. So you can trade FAS, which is the leveraged ETF for financials. And we are in JP Morgan here, and you can see JP Morgan's been showing relative strength even to the industry, so that's why we like it. We're looking at this level. It's kind of in the middle of a range now, so tough to enter here, but we're looking to take profits at the high here at 318. If I was watching this for an entry, I'd watch for a break of this 318 level or a pullback to get in at a little better price. So, and of course, there's these other ones too. KRE is regional banks, not the big banks. And notice here, it's lagging XLF, but if you go in and look at some of the stocks that make up KRE, I would look at the ones that are showing relative strength. Those might be some good plays as well with the smaller banks. Quantum, we're not going to look at all of these. Let's just look at, say, QBTS and VST. So here's QBTS. And you can see here, been on an amazing trend, broke its IPO high here earlier this year, and pulled back deep from 46 all the way down to 27. So what would that be, like a 35-40% move down? But notice here, finding support at the 50-day moving average. If we were to show a little strength here Monday or Tuesday, I think this would be a good position. You could have even entered this on Friday. And then VST here, we're going to see something similar here, maybe a little more messy, but similar pattern here. We're in Oklo, and we actually loosened our stop here, this deep pullback. If I was looking to enter, I would watch for it to break the 50-day moving average in the 90 MA here around 125. Okay, that's quantum. Industrials, not only have they been strong and showed relative strength, they also tend to do good November, December. So here's XLI. Now I talked about, I don't have a list of stocks here because I want to show you guys, especially you guys who don't have maybe a ton of time to put into going through all of these stocks. An easy way to do it, like say you like an industry, and there's a lot to like with XLI, again, because of seasonality, and also because it showed relative strength on the pullback here. Notice it pulled back very light. So we know then there's some stocks in here that we would like. A trick that I like to use to get a good list of stocks very quickly: take the ETF, take the list, take the stocks that make up that ETF. If you click this little bullet point thing here in TC2000, you get a list of all the stocks that make up XLI, and then sort them by the leaders over whatever time period you want to do. So we'll say 30 days here. These are the best performers over the last 30 days, and then we'll just start looking at the ones we like here. JP Hunt, earnings breakout, Caterpillar, another one that was already in a good trend. I like Caterpillar a lot, and now a breakout pullback on earnings. UPS has been an ugly stock in a big downtrend, but for the first time in a long time, broke out on earnings. I'm watching this thing to get up over the 200-day moving average, which essentially breaks the downtrend. So this is a good way to, and here's JCI, very strong here. So this is a good way, easy way to build a list of stocks within a specific industry. Big tech. Let's go through a few of these. Let's go through the main ones. Netflix gapped down on earnings, and this is one we've identified as a potential earnings breakdown reversal, overreaction to earnings. This is the spot we're looking at. If it pulls into the gap here around 1150, that's where we're looking to enter. And this would be a great candidate for using options, especially something like either a synthetic long or a bull call spread, because again, $1,100 stock, you can make it much cheaper by using a bull call spread. All right. Big tech. Amazon, we're in Amazon right now. Love the hammer here that formed at the old high and the 9 EMA. Meta, another one that had a negative earnings reaction. This one may be gap down. Generally, I like the gap downs when they pull into the gap. So here in the 200s here, so maybe 680. But this hammer is very strong, so maybe you can trade it off the hammer. NVIDIA has earnings coming up, so we're not going to touch that. Microsoft is interesting in that broke out here, has had earnings, and also has made a ton of deals related to AI companies and data centers, yet the stock has dropped a lot. So that's kind of weird. But it is testing this range here at about 492. So we'll watch that link level closely. Apple has shown relative strength. I think it's good where it is at the 9 EMA. And then AMD, we talked about. I like it here. And this would be a good candidate for a bull call spread as well. Oh, and Google has shown relative strength and looks good where it is right now. All right, so that's big tech. Let me go over one of the rare earth metals that I like, and that's it's actually I think batteries related to that. Here's ABAT. It's in this industry, but I think it's more of the energy and power related to it. But a lot of the metals have done this, made this high, have pulled back hard, and now watch for them to get back on trend. So for this one here, very low risk. If it gets up here at 475, place a stop. I mean, think about the risk reward. You enter here at 475. Let's say you target right here at 890. That's almost 100% gain. Yet you could risk maybe 30 or 40 cents for that big move. So really good risk. If you get stopped out, big deal. It's a small loss, but you have the potential for a big win here. And then we've got a list of stocks that have had earnings, both gap ups and gap downs, that we're interested in here as well. And all of those strategies that we talked about here would relate to the stocks on our earnings list. All right, so that's what I wanted to get through today. If you guys have any questions, either related to what we talked about, game planning for next week, or you have questions about the options, you can ask them here. Obviously, you can contact me, singjd1@aol.com, or contact Bulls. I'm on Twitter and Instagram as well, the real Paul J. Singh and Paul J. Singh. Check out Bulls on Wall Street blog. I'm going to post something tomorrow. And then this article here on my site on Bubbles, I think you should read that. It'll help you kind of identify where we are right now and what you should be looking at in the future. All right, let me see if you guys have any questions. Tom, yeah, you don't have to hold to. So Tom, what Tom's asking is, We talk about break even at expiration. That's the way you always calculate it. But I don't just look at what's going to happen at expiration. You want to look at the whole thing, the big picture. Notice your break even is much lower here because time decay hasn't hit you as hard. So if you only held to here, you can get out at a lower break even. And notice here, if it hit your 150 early, you make more than if it hits at the end. So yeah, you don't have to hold to expiration. Okay, Brent, good job answering that. Kurum sees a Head and Shoulders. Yeah, a lot of these stocks were at interesting spots where they were forming potential topping patterns, but they hadn't broke the neckline yet, and they're finding support at that level. But if they do go further down, they do confirm topping patterns, but no confirmation yet. Tom, shoot me a message, and I have a list of how I look at candle patterns, which is not necessarily how a lot of the books do it, but I can send you that. Tim missed the start of this. Yeah, for sure. A recording will be out later today, and you can, if you're a swing member, I posted in the swing chat. Otherwise, if you're on Bull's email list, you could get it through there, or just email me singjd1 at AOL.com, and I'll send you the link. Okay, that looks like the extent. Jim, the class is not an alert service. It's going to be a class teaching you how to do this. And it's going to start on the 18th. And there'll be 5 sessions, 3 kind of lesson-based sessions. And this is very practical. I've done an options class in the past that was basically teaching you how to do it. This one's going to put a lot of this stuff into practice with the swing stuff we do. So there'll be a half session on swing setups as well. And then Kunal actually has decided to jump on a 5th day, and he's going to go over day trading options strategy as well. So there's going to be a lot of stuff in this class. All right, good. All right, so we're going to do during the week, we're going to do a webinar specifically on options to kind of get you ready for the class. And then we'll do another Stocks and Coffee next week. Those of you who are swing members, I'll see you on Monday or today in the chat if you jump in there. Otherwise, great session as usual, guys, and I will talk to you guys soon.